Hi, I'm Jeff Hibbeler, Senior Portfolio Manager with Exencial Wealth Advisors, and today I'm bringing you an economic and market update following May's employment report. Following last month's large miss of employment growth compared to expectations, economists' estimates were again wide-ranging for May's payroll growth. The distortions to forecasting caused by the pandemic, in addition to extended unemployment benefits and some workers' challenges participating in the labor market, have made it difficult predicting this important economic indicator. All things considered, though, this month's data came in relatively close to consensus and posted another solid month of job growth. Headline non-farm payrolls grew 559,000 compared to estimates of around 675,000. Most sectors posted gains, with the leisure and hospitality sector leading the way at almost 300,000 in job gains. And that's good news for the sector, which has been hardest hit by the pandemic. The education and health sectors also grew a strong 87,000 jobs, while manufacturing regained most of the jobs that it's lost last month, with 23,000 in job growth this month. Semiconductor chip shortages have been affecting auto and other manufacturing, and that's likely been reducing the manufacturing sector's employment. State and local government was also another strong growth sector at a little over 70,000 jobs for the month of May. Now, interestingly, construction lost about 20,000 jobs. And this looks to be more of a seasonality issue with, we've seen stronger hiring earlier in the spring, but it also may speak to some labor supply shortages given the strength in the housing market. The unemployment rate ticked down to 5.8% from 6.1% last month. The good news in this decline is that most of the improvement was due to 444,000 job growth, and this is in the household survey. The disappointing news in it is that the labor force participation rate declined to 61.6%, and that is compared to an estimated increase to 61.8%. And that decline resulted in a small contraction in the labor force. The labor force participation rate is running around 1.5% to 2% below pre-pandemic levels, and bringing that closer to historical averages is quite important for our economy's long-term health. Certainly, this is one of the payroll indicators that the Fed is focused on, and they're going to do what they can to push it higher. The broadest unemployment measure, the underemployment rate, did fall in the month to 10.2% from 10.4%. Average hourly earnings were somewhat above estimates at 2% year over year, although that has cooled off somewhat compared to recent growth rates. Now, the average hourly earnings has been heavily skewed throughout the pandemic due to compositional effects of the labor force, and other wage measures such as the employment cost index are actually likely better indicators. Looking at average weekly hours, those stayed flat at 34.9, and those remain near the historical highs for that data series. The market reaction to the payroll numbers really showed that the markets kind of took the numbers in stride. The 10-year Treasury rallied a few basis points, and shortly after the data was posted, was trading around 1.59%, and that's well within its recent trading range. S&P futures also rallied and were up about 0.5%, which would leave them near their all-time highs. Thank you for watching today. We'd love to hear your feedback on today's video, or if you'd like more information about Exencial Wealth Advisors, please visit our website at exencialwealth.com. Thank you.